Well, the numbers, if you go back 5 years, the numbers we all use are the Silver Institute numbers, and whether they're how accurate they are, people can have their own opinions on that. But the number fluctuates between 150 and 250 million ounces a year of physical shortages, and that's been going on consistently for the last 5 years, as I said. Doesn't look like this year's any different. Doesn't look like next year's going to be any different. Like, where's the silver going to come from? As a human race, if we're going to be consuming 1.2 to 1.4 billion ounces of silver in industry, that's including investment as well, including ETFs. But how can the miners ever fill that deficit? It's just not going to happen in this current price environment.
Keithneumeyer, a longtime industry veteran, highlights a critical imbalance that few investors truly grasp: the ongoing and structural deficit in global silver supply. For the past 5 years, the world has faced annual shortfalls of 150 to 250 million ounces, according to widely cited industry data. This isn't a temporary blip or a one-off shortage. It's a pattern, and it's not easing. Global industrial demand, from solar panels to electronics, now consumes 1.2 to 1.4 billion ounces annually, and that's before factoring in investor and ETF demand. Yet, mining output has stagnated, starved by years of underinvestment and unsustainably low prices. The math doesn't work. Without a higher price to incentivize new production, the gap will continue to widen, and eventually the market will reprice silver sharply higher. If you found this analysis helpful, make sure to hit that like button. Share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
Silver is a bit of a clunky metal, so it's hard to move around. And there was a lot of metal, gold, and silver moved to the United States as a result of the tariff issues. And I guess in hindsight, maybe some of that metal shouldn't have moved, but in fact, it had to move back. So the London market is really where all the price fixing occurs, and it's a market that needs that metal, and it was obviously very stressed, and they needed the metal back. And I saw some stats just, I think, yesterday that India was a huge consumer of silver this past month. And we know China is now, I just saw this morning, actually, that China is stopping silver deliveries outside of the country. And so we need this metal. And that's why I'm a triple-digit silver guy. I came up with that phrase back in 2011, 2012. I was the first to say it. I was criticized for almost 15 years for coming up with that phrase. I was wrong because silver went down to $12, but I didn't put a timeline on it. I will. My timeline is out in the future because I'm a long-term investor. I don't care about these daily fluctuations. It's irrelevant to me. I look at the big picture, the supply demand fundamentals of this metal. If we're going to electrify the planet the way we want to electrify the planet, and governments are going this direction, nuclear power plants are being built all over the world now, which are huge consumers of silver, rebuilding electrical grids or building brand new electrical grids, in places that don't have availability for electricity. Every time you move electricity around the world, you need silver. And I think that, where was the light that really changed the market? I think when the United States put silver on the critical minerals list, I think that was a pretty important signal to the market and to the big institutions. I've come up with phrases over the last 20 years of my career calling silver a strategic metal. There's no substitute for metal, or silver. I've come up with these different phrases, but for the United States government to all of a sudden say silver is critical, and that I think really changed the market a lot. Well, in a market where it's driven by paper prices, we've seen, the paper prices come to the mercy of the physical market. And, we trade somewhere around 2 billion ounces of silver per day between London and Shanghai and Chicago. That's a lot of silver in one day to trade, considering the miners only produce, around 850 million ounces a year. So, that's pretty crazy leverage. So, all of a sudden, the paper market gets untwinged or whatever, however you want to say it. All of a sudden, they have to get the metal because they need some metal to back up all their paper contracts. And it's not the only time we've seen it. We've seen it in the nickel market previously. We've seen it in other markets as well. And we saw it in the silver market. We saw it in the silver market in 2011. I remember when, that whole move from, low 40s to almost 50, that was all short covering. We didn't see a huge short cover this time around. It was more physically driven this time around, which is interesting. I think that tells you that there's a huge physical shortage in the market, but that shows up in all the stats. We already know that the silver's been in deficit for 5 years now. So you just can't continually run in a deficit in the physical market and not have it show up in the paper market, and that's what we're seeing. Well, the numbers, if you go back 5 years, the numbers we all use are the Silver Institute numbers, and whether they're how accurate they are, people can have their own opinions on that. But the number fluctuates between 150 and 250 million ounces a year of physical shortages, and that's been going on consistently for the last 5 years, as I said. Doesn't look like this year's any different. Doesn't look like next year's going to be any different. Like, where's the silver going to come from? As a human race, if we're going to be consuming 1.2 to 1.4 billion ounces of silver in industry, well, that's including investment as well, including ETFs. But how can the miners ever fill that deficit? It's just not going to happen in this current price environment.
Silver's global market is entering a critical phase. As industrial demand surges and government policy pivots toward electrification, supply constraints are tightening across the board. The United States now classifies silver as a critical mineral, reinforcing its role in energy grids, solar infrastructure, and next-generation electronics. Yet, physical shortages persist, around 150 to 250 million ounces annually for 5 consecutive years. Despite the illusion of liquidity in paper markets, only about 850 million ounces are mined each year, while nearly 2 billion ounces trade daily between London, Shanghai, and Chicago. As real metal becomes harder to source, the system's leverage will unwind, forcing paper and physical prices to converge, likely at much higher levels. Let's get into the interview.
I was a little surprised it happened so quickly, and it did make me nervous. I don't think parabolic moves are in anything, whether it's a stock or whether it's a commodity. It doesn't really matter. Every kind of major move like that, it tells you there's something changing in the market for sure. I think it's signaling something about the future, but it did get a little bit ahead of itself. And I was, questioning, where is the top going to be? And, I listened to all the same people you probably listen to, and, people calling for $60, $70 and so on and so forth, but no one has a crystal ball. But it had to stop, and it did stop, and then it hit close to $55, which is kind of nice to see. And our stock was doing well, the whole mining sector was doing well. Gold's 4,400, almost 4,500. So the whole mining sector lit up and put a lot of smile on a lot of people's faces, like myself, who've been in this bear market since 2012, 2011, 2012. We had a bit of a blip in 2016 and another blip in 2020, but those are short-term blips. But I think things are changing now. You've got the central banks buying gold now, and they weren't there 10 years ago. You now got the market waking up to the industrial needs for silver. So there's now a whole set of new buyers coming into the precious metals market, which didn't exist in the last bull market. And I think that what we've seen in the last 2 months is a signal of the future. Yeah, you're going to get big investors offside, whether they're long or short, anything. Doesn't matter if it's a stock. It doesn't matter if it's commodity, as I said earlier. These big hedge funds, big banks that have positions that might be offside, they're going to try to protect their book as much as possible. And they don't like losing money. So, at $55 silver, 3,450 gold, I think that took a lot of people by surprise. And I think there was a lot of traders, a lot of big funds out there that were just offside, and they had to have a correction. So, they wait for the right timing. And look, buying does get exhausted at some point. In a bull market, people just get tired, and then the buying ends. And that's what we've seen happen. It ended, and now the market needs to consolidate. And usually when you see a parabolic move like that, to see a 15 to 20% correction is normal. We hope to see that. I think we're about 15% already as of today. Today's a great day for an interview. I see my screen is covered in red, which is unfortunate. I love talking on a green day, but
Yep.
Nevertheless, we're down about 15%, and who knows where the bottom is, but it's going to
Right.
settle. It'll find a level wherever that level is, and then it'll sit there for 2-3 months, and I think the bull market will resume.
When markets move parabolically, they always command attention, not just for their speed, but for what they signal beneath the surface. The recent surge in silver toward $55 and gold nearing $4,500 wasn't just excitement. It was confirmation that a new class of buyers has entered this cycle. From central banks accumulating physical gold to industries awakening to silver's critical role in electrification, the market dynamics today are fundamentally different from a decade ago. Corrections, though uncomfortable, are essential. A 15 to 20% pullback is not weakness. It's a reset before the next advance. The exhaustion of short-term traders clears the way for stronger hands. And once consolidation stabilizes, the next leg of this bull market will likely surprise even seasoned investors. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.